Just want to look at not being caught out by taking on more risk than you thought you were actually comfortable with. Of course, what everybody wants is only upside moves, and as soon as you buy something, it only goes in one direction, and even if the markets fall, it just continues going in the same direction. That doesn't happen in the real world. If we look at a selection of stocks here, what you can see is, and the things that I want you to focus on are the volatility levels. If you look at this, the average volatility here is close to, it's an average of about 20%. Okay, now bear in mind that some of these stocks, like Microsoft, is at 11% volatility. Now, are you on a scale of 0 to 10, where 0 is Microsoft, probably the lowest volatility stock I can think of, or pretty much there, and 10 is, a Crocs, 45%. Where are you on that spectrum? Now, don't get me wrong, Crocs in the last, 7 months has gone up 100%, but that's with a 45% volatility, which is fine if it's only on the upside. So first thing to think about is, do you really want some of the more volatile ones? Of course, you want the returns they can generate, but are you willing to take the downside? Let me put that another way. Let's look at their betas. Again, I've marked in pink the beta. A beta is, if the market goes up 1% and the stock's got a beta of 2, the stock should technically go up 2%. Similar, if the market falls 1%, those are the stocks that are going to get beaten the most. They're going to fall back 2%. It's got a beta of 2. Now, if you look at this is an average beta here of about 1.3, which isn't too bad. It means on the upside, you get a 1.3 to every 1 on the market, but on the downside, you'll get hit a bit. It's not getting the hit a bit that's going to worry you. What's going to worry you is not these stocks which might fall if the market falls, because they're not going to fall much. You're going to panic over these. You're not going to look at the portfolio as a whole, which you have to do. So you're happy having some of these higher beta stocks, okay? And to give you an example of what I mean is, there's a higher beta, that's 32% off its highs. Are you okay with a stock being able to drop 32% of its highs? And in my stop loss, because anything that drops 25% of its highs I exit, I'd have to exit that, okay, even though it gave me great gains up to that point. Similarly, if you look at a Microsoft, guess what? Lower beta gives you some downside protection on the market, so might be more suited to your risk profile. That's only fallen 5% off its highs as well. So put those factors into account. A 2.8 beta, not surprisingly, has fallen 13% off, because when the market falls, they're the ones that are falling more. Now, of course, you can have a high beta which doesn't fall so much and has got a high volatility, but be careful, that's a rare mix, and these numbers are not static, they move with the markets. So I want you to bear in mind, do you really want high betas? Because the outcomes could be sharper falls when the markets move to the downside. Get an understanding of your risk profile when you're selecting, and that'll make it easier for you to sleep easy at night.